Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets.
Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we're going to dive into the latest CPI release for the month of May, what it might mean for the Bank of Canada, and what it doesn't mean for Canadian households. So let's get right into it. In truth, the May CPI release was a damp squib. That is to say, it was a bit boring, or in line with expectations. The Consumer Price Index, CPI, rose 1.7% on a year-on-year basis in May, matching the 1.7% increase in April. This means that for nearly a year now, headline inflation has been in line with the BOC's control target range of 2% plus or minus 1%. So what do we mean by expected? Well, for many of the most important market-moving statistics released by a country's data house, there are companies like Reuters and Bloomberg that aggregate expectations from economists and provide a consensus estimate. How far away the data points are from those consensus estimate is usually the main headline. For inflation, if it's too high, then a central bank might be seen as behind the curve, or if inflation is well below expectations, then a central bank is deemed to be too hawkish or monetary policy is too tight. Simultaneously, currency and bond markets might react to what was released versus those expectations, and that is something that we pay a lot of attention to. In May, mostly everything was in line, as you can see from the table, but this doesn't mean that there weren't some important takeaways from the release. So let's highlight some of the things that did stand out. On a monthly basis, the shelter component at the bottom of the chart was 0. This is a big deal, and we'll dive deeper into what that means in a minute. At the top of the table, we have services like recreation, education, healthcare, and personal care, which I would have thought would be feeling the pinch from sluggish employment growth and weaker demand. Anyways, again, this is a monthly change chart, so we shouldn't read too much into it, but it's certainly worth noting. Year-on-year data better highlights trends in prices, and that's what Stats Canada focuses on. Here, rising food costs should concern us all. For people on the lower socioeconomic ladder, food is a larger share of their consumption basket, and so this is really hurting them. To be clear, I'm very sympathetic to the complaints that these CPI components are underreport the inflation we have all felt. I swear my meat prices have tripled, but nevertheless, this is the data we've got, so bear with me. We always like to break out services from goods because services are stickier and more stable, and they reflect domestic economic realities about like labor markets rather than moving at the mercy of global commodity markets like oil, which dominates the goods index. Note that services are ticking along at roughly 3.25%. In June, Stats Canada highlighted that the removal of the carbon tax lowered CPI. I've recreated their chart for you here. This was then reiterated by the BOC governor in the presser from a couple weeks ago, much to the chagrin of the media and the politicians that have been lying to Canadians about this for years. What's interesting this month is that core X energy, in red, looks to have peaked. But, as you will often hear me say, one data point does not make a trend, so let's keep an eye on this going forward. Now, for shelter. In Canada, like many other countries, we can't talk about inflation without discussing shelter. In Canada, it is 68% of the core basket. But as you can see on the bottom panel, its contribution to core is now at its lowest level in years. The shelter component only grew at 3.0%, down from 3.4% in April. One of the main reasons shelter is falling is because of the increased availability of rental units coupled with slower population growth driven by lower immigration. However, one must be careful here. Ontario is a huge weight nationally, and it hides the faster rental growth in 7 other provinces. Note that the CPI rent component has probably overstated rental changes over the last couple of months, and we know this because more real-time, market-based data is already printing negative year-on-year numbers in many Ontario cities. Another major contributor to shelter inflation has been rising ownership costs, specifically the mortgage interest cost component. But as you can see here, the mortgage interest cost index in gray is falling fast and has decelerated for a 21st consecutive month in May. Interestingly, all items ex mortgages in red looks to have bottomed late last year. In our view, this means that there is some underlying inflation pressure. And this is corroborated by my favorite, the BOC's 3 preferred measures of core inflation, which looks to have bottomed in late 2024 and is marching steadily higher. So what does this mean for the BOC and Canadians? Well, given the BOC's single mandate targeting inflation and rising core measures seem to be holding up the future path of interest rate or expectations, those little dots on the chart, those expectations are based on overnight index swap, which is a way that people can bet on the future path of interest rates. If you extrapolate, you can get probabilities, which I'll show you in a second. But as you can see, they are basically flat, which translates to between 4.5 and 5% for 5-year conventional mortgage rate. It also means that the market is increasingly convinced that the rate cutting cycle that we're in is over. Zooming in, we can see that for the next month, cuts are very much uncertain. There's a growing number of analysts that are suggesting that the BOC is done with its rate cutting cycle, full stop, unless of course something drastic happens. Linking the BOC's decisions on the front end of the curve, expectations on inflation and growth, and the potential for a blowout budget deficit in the fall is the 5-year government bond yield and its flow through to mortgage rates and mortgage interest payments and that part of the debt servicing ratio, but with a lag. It's very important. In this case, we can see it's about 6 months. It also means that debt servicing ratios in total will likely stay elevated over the next few years, and we can see that in the next chart. Add that to the near record debt levels for households in aggregate, which includes mortgages and consumer credit, and we can see that total debt service ratios will stay elevated. And we expect this to be true for a long time. Now we'll weigh on consumption and saving and other types of investments. Fundamentally, Canada is dealing with a housing bust that is especially acute in places like Toronto and Vancouver. Our view is that the BOC is constrained by sticky inflation, and it's not even clear that cuts would help what is proving to be a broken market. There is simply too much unwanted product, and prices are going to have to fall. All right, that's a wrap on this week's episode. Thank you very much for watching. Please like, subscribe, and follow for more. As a reminder, we manage money for families all across Canada and the world, so please feel free to get in touch.